Now, throughout this course, we've talked a lot about internal audit, and we're going to wrap it up with 2 chapters that specifically look at internal audit and what their role is. The reason we're doing this is because internal audit impact on risk management organisation in a number of ways. For one thing, internal audit is part of an organisation's risk management process. And what they also do is they provide assurance over controls, the existence of an internal audit function acts as a control in its own right, and as we'll see, there are quite close links between internal audit and corporate governance as well. So we're going to cover all those ways in which internal audit touches on risk and control strategy. We'll start off this chapter by looking at what internal audit actually is, just to be really clear about what we mean by internal audit. We'll then look at what internal audit does, and there's sometimes a bit of confusion about this, so it's important to be clear. Fundamentally, what internal audit does is provide assurance that controls are operating effectively. We'll return to this point, but it is not the job of internal audit to actually operate controls or to set policy around risk management. We'll also make sure that we're absolutely clear about the difference in role of internal audit and the risk management function, and indeed line management, because they all have a different role to play in terms of managing risks. Now, internal audit can carry out all kinds of different audits, and we'll look very briefly at what they are and all the different things they might be asked to do. And in particular, because this is specifically mentioned in the syllabus, we're going to contrast internal and external audit. Although the work that internal and external auditors carry out can be quite similar, their role is fundamentally very different. So we need to be clear about this. And then we'll round off by looking at how you can assess the performance of internal audit and what sort of measures you could use to see whether they're doing a good job or not. We're going to start off with the definition of internal audit supplied by the Institute of Internal Auditors, and I'll just pick out a couple of key terms here. An internal audit function needs to be independent and objective. An internal audit is an independent assessment of something. So it can't be done by the people who are actually carrying out an operation. It needs to be done by someone who is outside the operation. It's designed to add value and improve an organisation's operations. So internal auditors don't just carry out audits for the sake of it, they don't just carry it out in order to recommend more controls. They are trying to help the organisation achieve its objectives. That's their overriding aim. And how do they do this? By looking at things in a systematic, disciplined way. So this is not an ad hoc review, it's not a one-off process, it is something that is systematic, planned, and follows a certain structure. So otherwise, have a read through that definition, making it clear what internal auditing is about. As we mentioned in the introduction, what it's fundamentally there for is to provide assurance to management that within the organisation the key risks are being managed and that controls are operating effectively. So management, remember, if you think right back to corporate governance principles, management have a responsibility to ensure that controls are effective and risks are being managed. How do they know that's happening? Well, they have internal audit, among other things, going and doing reviews. Now, do be aware that not all businesses are going to be appropriate to have an internal audit function. They don't all need or can justify one. And this is a very important point when you're dealing with certain scenarios in the exam. If your scenario is a small business that perhaps employs 5 people, then it wouldn't be appropriate to recommend an internal audit function. It's just not big enough to justify it. However, a larger company, it may well be appropriate, and it may be something to look out for as to whether they do have an internal audit function and whether this is something you should be recommending. In particular, for listed companies, under corporate governance best practice, and this is one of the links between internal audit and corporate governance, under corporate governance best practice, listed companies must consider the need for an internal audit function. So at least once a year, they need to look at whether it would be appropriate for them to have a function. They are going to do this by considering the types of risks and operations that they carry out and whether they can justify an internal audit function to add value to the risk management over those operations. So they need to think about whether they need one. Now, for listed companies of any size, in practice, they really need to have an internal audit function. Otherwise, the shareholders will want to know why. So for those companies, unless they've got a really good reason, they'll need one of some sort. For listed companies that already have an internal audit function, they need to review it once a year. They need to review its scope, its authority and resources. Basically, they need to review, is it doing a good job? And if they don't think their internal audit function is doing a good job, they need to take action to deal with it and improve its performance. Now, it is possible to be more specific about the role of internal auditing, and the acronym SCREAM can be quite helpful in thinking about the range of goals they might have. The precise objectives are going to vary from organisation to organisation, but will usually include some of these. One of them I will just highlight is reducing overheads. Quite often internal audit can be involved in identifying inefficiencies and helping to reduce costs. They will also be involved in the overall management of risks, and as we'll see, they may sometimes be called upon to audit the risk management process itself. Now, it is important that you are clear about the distinction between the role of internal audit, the internal audit function, and the role of the risk management function. To help clarify the different roles of internal audit and risk management, have a go at this short exercise. There's a number of roles listed out, and just tick which ones you think belong to internal audit and which ones belong to risk management. So press pause and then press play when you're ready to debrief. Okay, so whose responsibility is it fundamentally to build a risk-aware culture? Well, this is the responsibility of the risk management function. Internal audit may have their place in terms of raising awareness of risks, but it's not fundamentally what they're aimed at. It fundamentally is what risk management is all about. What about providing guidelines on overall risk policy, perhaps on what risk tolerance the organisation should have? Well, again, that is risk management. It's up to them to decide what the policies and central guidelines and overall approach of the organisation should be, obviously under direction from the Board of Directors. Whose job is it to report to the Board on the effectiveness of internal controls? Well, that is squarely internal audit. Internal audit will go around the organisation, review procedures, review controls, come back to the Board with their conclusions. Designing risk analysis procedures for the organisation, so working out how risks should be considered and dealt with. Well, again, that is the risk management function. This is not the job of internal audit to actually design the procedures in the first place. Reviewing the effectiveness of an organisation's risk management process, on the other hand, well, that's got to be internal audit. As you'll see, an organisation with a risk management function, that risk management function is going to be responsible for the risk management process. They've set it up in the first place. So it wouldn't be appropriate for them to review its effectiveness. They'd effectively be reviewing themselves. So internal audit, as an outside, independent view, can review that. And coordinating line managers involved in dealing with risks and making sure they're aware of policies, that is the job of risk management. Again, that falls very much into the category of dealing with the organisation's overall risk management policy. So hopefully that makes the contrast a little bit clearer between the two functions and what it is they do. It's important to understand that internal audit can be asked to carry out a wide range of types of audit, and in the next section we've got an overview of some of the more common ones that you need to be aware of. Now, you've got some quite detailed descriptions here, so I'll just pick out some of the important points. One of the more common types of audit is referred to as a systems audit, and this means that the auditors will review a system. Most commonly this term is used in relation to IT, but it can also apply to a paper-based system. The auditors will review the system to determine whether it is achieving its objectives and whether the controls in place are adequate, and quite possibly make recommendations for how they can be improved. Now, one variant on a systems audit is a compliance audit, which checks that a certain system is in compliance with the appropriate laws and regulations. So, for example, you might ensure you are compliant with health and safety legislation and regulations, or you might look at areas such as employment law and check that your HR procedures are compliant. So systems audit, very, very common type of audit. Internal auditors might also be asked to do what's referred to as a risk-based audit. And what this does is it evaluates an organisation's risk management process. So earlier on in the course, we looked at the risk management cycle and the procedures by which organisations can manage risks. Well, what the internal auditors might do is look at that procedure and see whether they think it's effective, whether there are recommendations they would make to improve it. Now, a third category of audit that's particularly found in the public sector is value for money or best value audit, and these are particularly carried out by two bodies. Firstly, the National Audit Office look at central government and central government agencies to check that they are delivering on their objectives and that they are providing the taxpayer with value for money. I would strongly recommend having a look at the NAO website. It's got a load of information on there, and they publish all their reports because they're accountable to the public. So by downloading a couple of their reports, you can see what an audit report looks like and what sort of recommendations it makes. And the NAO reports do tend to be very thorough and very detailed. Most private sector internal audit functions, the equivalents, will, for obvious reasons, not make their reports public. The Audit Commission looks at local government and assesses local authorities, again to see how they're performing and whether they're delivering on value for money. Organisations may ask internal auditors to do a management audit and check whether their management are effective and whether perhaps action should be taken to improve the quality of management, such as additional training or appraisal processes. And then one that's been gaining a lot in importance in recent years is social and environmental audit. Most large companies nowadays will publish some sort of environmental report, and quite often they will get this audited either by their internal audit function or, increasingly, by an external body of some sort. Now, I'm just going to illustrate this by having a quick look at the HSBC sustainability report. So most large companies will publish them, just picking on HSBC here. And you can see the sorts of things it deals with. Now, a particular focus for HSBC has been climate change and their contributions and how their lending impacts climate change. So you can see they're trying to work on their lending book. They're looking at using renewable power. They're looking at getting their computers to be automatically switched off and so forth. Now, what HSBC have also done, and again this is quite common for many large organisations, is they have commissioned an assurance report, which is a sort of audit of their sustainability report, which in this case has been carried out by PwC, who are also their financial auditors. Now, these assurance reports vary quite a lot, and they tend to be quite specific about what they are and aren't saying. So if you have a read through the report, and I'd recommend you have a look at this or perhaps similar reports, what they're saying is that they consider whether the information is consistent with the knowledge gained from their procedures. So what they're saying is they will flag up if they become aware that any of the information is wrong. But this falls some way short of the sorts of financial audits that we'll look at very shortly. So the conclusion of the audit report, and again this is just an illustration, the conclusion is nothing has come to their attention that makes them think that the report is wrong. So that's pretty much the only sort of sign-off you can really provide on this type of report. Now, this leads us quite neatly into contrasting internal auditors with external auditors, and there is a specific syllabus outcome that requires you to understand the difference between the two. Now, the table sets this out quite clearly. Internal audit is responsible to management. Okay, ultimately they will report in, ideally to the audit committee, but ultimately to the board of directors, so they report internally. And they are responsible for, and they will do, basically anything that management wants them to do, anything that management feels they need in order to gain assurance over the controls and effective risk management in the organisation. Now, external auditors, by contrast, have a very prescriptive approach and a very prescriptive outcome. External audit, for a start, are not responsible to management. They report to the shareholders of an organisation, and their report, and we'll look at an example report in a second, their report is very specifically directed to the shareholders. Now, in practice, of course, their relationship is with management, and they deal quite closely with management, but their responsibility is to shareholders. External auditors are responsible, when they're carrying out financial audits, they're responsible for one thing only. They are responsible for providing an opinion on the truth and fairness of the financial statements. So at the end of all of their work, the external auditors will supply a view as to whether they think the financial statements of this organisation are true and fair. In other words, they're not likely to mislead any user of those financial statements. That is it. That is all they do. In particular, just to mention, external auditors are not responsible for things like detecting fraud. Okay, that is not part of the responsibility of external auditors, unless the fraud is causing a material misstatement of the financial statements, in which case it is their responsibility to pick it up and modify their opinion accordingly. Now, having said that, if the external auditors in the course of their work become aware of a fraud or indeed a control weakness, it is common practice for the auditors to report that back to management in what is known as the management letter. So auditors usually at the end of an engagement will compile a management letter which will comprise recommendations and issues and things they feel need to be brought to the attention of management following their audit. However, this management letter is just a matter of client service. It's not formally part of their responsibility. What do external auditors do? Well, they do testing in order to arrive at their opinion on the truth and fairness of the financial statements. And in contrast to internal auditors, who can follow whatever procedures they like, external auditors are prescribed that they need to comply with the Companies Act 2006, and in particular they need to make sure the financial statements comply with the Companies Act 2006. They need to comply with the international standards on auditing, because in the audit opinion they say they are complying with those standards, and they need to make sure that the financial statements comply with international accounting standards. Now, just to illustrate some of these points, I've got an example, again from HSBC, of an external auditor's report, but these are very, very similar. There is a very standard format. So first thing I want to pick out is the fact that the independent auditors are reporting to the members of HSBC Holding, in other words, the shareholders in HSBC, and that's who they're specifically directing their report to, not to the management. They are also very clear to set out, and again this is standard stuff, they set out the contrast between the auditor's responsibility and the director's responsibility. And they just want to re-emphasize, and this is a point of law anyway, but they're re-emphasizing to the members that the directors are responsible for preparing the accounts in accordance with accounting standards and the applicable laws. So just to be absolutely clear, that is not the auditor's responsibility, it's the director's responsibility. The auditor's responsibility is to audit them and give an opinion on whether they are true and fair, whether they're compliant with the applicable regulations. They also do some review of the corporate governance statements and some of the other information. They will raise it if they're aware that any of that other information is incorrect, but they don't carry out specific procedures to make sure that it is. As noted, they conduct their audit in accordance with the international standards on auditing, so they are required to follow those rules. Now, in certain other qualifications, you need to know what those rules are. Because you're doing CIMA, you don't. You just need to be aware there are some rules in place around this. And then at the end of all that, they come to an opinion, and this is what they actually deliver. In HSBC's case, their opinion is that the group financial statements give a true and fair view, the parent company financial statements give a true and fair view, and they're not aware of any problems with the rest of the report. Now that is what you would normally expect to see. You'd normally expect the auditors to come back saying, yes, these financial statements are true and fair, particularly if it's a large listed company. The shareholders would be extremely concerned if the auditors came back and said anything else. However, with some smaller companies or in certain specialised cases, the auditors may come back and say, actually, we don't think these financial statements are true and fair, or we think they're true and fair except for this. So that's also not unheard of. There are just a couple of other points to be aware of about external auditors and their relationship to internal audit. Quite often in practice, external auditors and internal auditors, as we'll see in the next chapter, perform quite similar work. And it is possible for external auditors to actually rely on the work carried out by internal audit. So, for example, the external auditors may need to know that the controls over cash processing are sound, because that's going to affect the work that they do. If the internal audit function has recently conducted a review of cash processing and concluded that the controls are good, the external auditors may decide that they can rely on that and assume that the controls are good. However, there's an important caveat here. In order to do this, they must assess, they must come to their own conclusion about whether the internal audit function is an effective control. In other words, they've got to decide whether they think the internal audit function is good and is doing a good job or not. Now, we'll look shortly at how you can do that, how you can evaluate an internal audit function. But politically and in practice, this can be a very, very delicate situation to be in. We just need to be aware of the principle they can rely on the work carried out by internal auditors. Now, you also need to be aware that the audit committee, who, as we know, have an important role in overseeing the internal audit function, are also responsible for the relationship with the external auditors, and the corporate governance regulations require that once a year at least the audit committee assess the independence and effectiveness of the external auditors. So do they think the external auditors are doing a good job and being sufficiently rigorous and sufficiently independent in how they form their opinion about the financial statements? The audit committee is then responsible for deciding whether they would recommend to the board that the auditors are retained or whether they should be replaced. Now, we've mentioned a couple of times the need to evaluate the internal audit function, and there are at least two situations in which such an evaluation is necessary. As we've noted, the board needs to evaluate its internal audit function annually, decide whether it's doing a good job or not, and external auditors might carry out some evaluation of internal audit to decide whether they can rely on its work. Well, how can they do that? Before we think about how you can evaluate an internal audit function, we need to set some standards for that evaluation. So think about what a good internal audit function looks like. You can come up with a very useful little checklist of 4 things that a good internal audit function should have. So for one thing, an internal audit function should have independence. We've seen that an audit is an independent review of something. So they need to be independent from the operations of the business. They're able to take a sufficiently detached view to come to an honest opinion about whether things are okay or not. A good internal audit function needs to have skills and knowledge, and this may be that they need to have specific audit knowledge, maybe audit qualifications, in order to carry out their work. Quite a lot of internal auditors are qualified accountants, and that may be where they get their knowledge of financial processes and also risk and how to audit things. But in addition to that, internal auditors also need skills and knowledge relating to the area being audited. It is impossible to do an effective audit if you don't really understand the area you're auditing. So this is particularly an issue if you're auditing specialist areas. For example, if you're auditing IT systems, you really need to have a good understanding of IT systems. If you're auditing finance areas, you need to know how finance works. If you're auditing HR, you need to have a good knowledge of how HR works. So, in order to do their job well, they need to have these appropriate skills and knowledge. To do their job well, internal auditors need to have authority. They need to be taken seriously. Firstly, to ensure that they have access to the information and the people that they need. So if internal audit make a request to see something or talk to someone, it needs to be followed. And secondly, internal auditors need to have authority to ensure that their recommendations are implemented. If the internal audit function makes lots of recommendations and nothing ever happens as a result of them, then it's just a waste of everyone's time. Now, if that's happening, then there's probably one of two reasons for that. Either the recommendations really aren't very good in the first place, or the line management aren't taking them seriously and aren't acting responsibly. Now, either way, that's an issue that's got to be fixed. And then finally, internal audit functions should have effective management. This is about use of resources. So they should aim to be cost effective. Internal audit is a function of the business. They are consuming resources that therefore are not being used making products or selling to customers or doing marketing or all the other things that organizations do. So they need to demonstrate to the board they are using those resources effectively. Now, having looked at what a good internal audit function looks like, we're in a position to think about some performance measures which could be used to see whether an internal audit function is doing a good job or not. So have a go at thinking up some performance measures you could use. And I'll give you a clue here. You can use the structure covered in the previous paragraph about what a good internal audit function looks like. So you can think about independence, skills and knowledge, authority, and effective management. If that's what we're looking for, then what measures could we put in place to evaluate whether that's what we're getting? Have a go at doing that one, and then press play when you're ready to resume. Okay, so what measures could you come up with? Well, independence is a tricky one because it's a bit of a subjective concept. But what you might need to do first is come up with some sort of definition of independence. So maybe it is someone perhaps who has not worked in the business for a certain number of years or was recruited from outside the business or something like that. And if you can set up a definition of independence, you can assess the percentage of your team, percentage of your auditors, who you would assess as independent. The other way you could measure this one is by getting some feedback from perhaps stakeholders or those being audited on the perceived independence of your team. But this is a tricky one because it's always going to be a bit subjective. Something like skills and knowledge, well, if there are formal qualifications that you think are appropriate, you could assess what proportion of your auditors actually hold a qualification. So how many are qualified either as auditors, because there are auditing qualifications, or perhaps as accountants if they're responsible for auditing finance areas, or have some sort of IT qualification if they're auditing IT areas. What you might also get is feedback on the quality of the reports, in particular looking at the audit committee. So go and ask the audit committee periodically, perhaps once a year, how would they rate the quality of the reports from 1 to 5, and then use that as a way of assessing the function. In terms of authority, a fairly simple measure you could use is what proportion of recommendations made by the internal audit function have been adopted. As mentioned previously, if recommendations aren't being adopted, it usually indicates there's a problem either with your internal audit function or perhaps with your line management. Either way, it needs to be dealt with. So you can measure how many of them were followed up. And most internal auditors, after doing a report, will go and revisit the area a bit later, maybe a year later, and see whether the recommendations has been adopted. So this should be relatively straightforward to check. And then effective management, well, the audit function would be expected to keep their costs within budget, like any other function. Now, allocated a budget for the year by the organisation, they'd be expected to keep within it. You could also look at efficiency measures, such as percentage of time actually spent auditing. as opposed perhaps to doing administration or overhead work. Now, if you remember, we previously looked at the ethical standards that are expected of qualified accountants, and you may need to think about how these specifically apply to internal auditors, so what the ethical standards might mean in terms of the internal auditors doing their regular job. So lecture example 3 asks you how this may be applied. So how might the principles specifically have relevance to internal auditors? So have a go at thinking that through. And just a reminder, in case you've forgotten of what the ethical principles are, remember you have the mnemonic PIPCO. So the ethical principles, you have professional behaviour, you have integrity, professional competence, and due care, confidentiality, and objectivity. Now, a number of questions to do with ethics in this paper in the past have revolved around internal audit, so this is really worth thinking through. So have a think about how those principles specifically would apply to internal auditors, then press play when you're ready to resume. Okay, so how might these principles be relevant? Well, professional behaviour can be a fairly critical issue. Internal auditors very often find themselves in a bit of an adversarial situation. The truth is, most people don't like being audited. They may get nervous that their errors are going to be discovered, and generally it probably feels like they're being checked up on. So the internal auditors can have a bit of a tricky job to do. The principle of professional behaviour requires, as with all accountants, but specifically relevant here, that they are courteous to all people who are being audited, that they aren't aggressive in their manner at all. At the same time, they mustn't be intimidated, or perhaps deflected, or discouraged from reviewing certain areas if managers or people that they're dealing with are particularly aggressive in their behaviour. So they've got to be pretty polite, but firmly insistent about what needs auditing. What about integrity? Well, it could be that they come under pressure by people in management to avoid certain areas. Maybe for various reasons there are parts of the business that some managers don't want to see audited, or perhaps to alter reports. If internal audit is going to issue a report that is very critical of a certain area, the manager of that area may feel very sensitive about it and may be able to apply pressure to change the conclusions. The internal auditor, of course, must resist these pressures. The internal auditor must act with integrity, which means being honest about the situation as they see it. They are not going to be influenced or deflected by any undue pressure that's applied to them. Professional competence and due care. Well, the principle here is that they have the skills to carry out the audits that they're required to do. We've already mentioned how important this is, particularly when you're dealing with specialised areas such as IT. What about confidentiality? Well, internal auditors, perhaps even more than most, have access to very, very sensitive information. So that information that's gathered clearly must be kept confidential and not be disclosed outside the organisation or indeed within the organisation. It wouldn't be appropriate for internal auditors to start gossiping about what they found out in a particular area of the business. Now, there may be an exception to this, which I'll just touch on, which is the case of whistleblowing. And whistleblowing refers to employees who find out something within the organisation that they think is very serious and that people within the organisation don't take seriously. So perhaps they go externally and report their findings. Now, this has been known to happen to internal auditors, and Paul van Buitenen in particular was a very high-profile case several years ago. The head auditor of the European Commission, who was so frustrated at the problems in the European Commission and the refusals to take them seriously that he went to the press, which resulted from him being sacked from his job and fighting a very long, high-profile legal battle. Now, whistleblowing generally is something that should only be done in extreme cases where perhaps there is a major compliance issue, something illegal is happening, or something very unethical is happening. But it has featured in a couple of exam questions in the past. And then objectivity means, well, as for all people, that you need to make judgments that are detached from the personalities. So it may be, for example, that the internal auditors find a problem in an area connected to a very senior manager, and they might be tempted to not report this or to modify their conclusions. Well, the principle of objectivity says that they shouldn't. They should make a judgment about their findings that has nothing to do with the people involved. Now, equally, they need to avoid any perception that they are victimizing or out to get certain areas or certain managers. So they need to detach from any personalities involved, just form their conclusions and just report based on the evidence they find. Okay, so let's recap what we've covered in this chapter. Well, we looked at exactly what internal audit is, and the fundamental function of internal audit is to provide assurance to management that risks are being managed and controls are being operated effectively. In terms of the role of internal audit, you can break this down a little bit by the acronym SCREAM, and it's very important to be clear about the difference between internal audit, which is a review and reporting function, from risk management, who have responsibility for risk management policy, procedure and coordination within the business. We looked at the types of audit that internal auditors may be asked to do, and in particular systems audit, which are very, very common, looking at whether a system, whether IT or paper-based, is operating effectively. You need to be very clear about the difference between internal and external audit and the relationship between the two. They have, although some of the work that they carry out might be similar, they have very, very different focus. We looked at how you might go about assessing the performance of internal audit, thinking about what a good internal audit function looks like, and turning that perhaps into a series of performance measures that may be used. And thought briefly about some of the ethical issues that may specifically apply to internal auditors, because this may be the background for a question about ethics in the exam.